This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Mike Savino. We've been in a seller's market for 2 years, even with home prices rising at rates we've never seen before. Now, we've known things will cool off, but it seems like the dynamic in the market is really starting to shift. In fact, some 60,000 home buyers canceled their purchase agreements last month, equal to 15% of all homes under contract. That's the highest percentage of deals being canceled since March and April of 2020, when the early days of the pandemic brought the housing market to a standstill. Rising rates and prices are certainly a factor. Some buyers have backed out because rates increased between the time they made an offer and when the deal was set to be closed, making the total cost just too much for them. But we're also seeing that the slowdown in the housing market competition is giving home buyers room to negotiate, which is one reason more of them are backing out of deals. Buyers are increasingly keeping rather than waiving inspections and appraisals, and that's giving them time to either back out of their deal or seek concessions from sellers. So how can originators make up for the business that you lose because a borrower backed out? Well, one way to offset that loss is to expand your customer base and increase your overall volume. Groups of borrowers that have traditionally been underserved are playing a bigger role in today's market. And our own Katie Jensen caught up with an expert at the Ultimate Mortgage Expo in New Orleans for tips on how to tap into this stream of business.
As we know, millennial borrowers will be one of the fastest cohorts of buyers, not only today, but for the next several years. And our goal is to help brokers understand how they want to connect, engage with the lender to be able to capture more of this market.
Tony Thompson founded NAMBA. He says now is the time to capitalize on borrowers who have been pushed out of the marketplace over the past few years, particularly multicultural borrowers.
The multicultural market, which consists of women, single females, millennials, communities of color, so Asian, Latino, African Americans, and Native American, as well as the LGBT community, represents $2.9 trillion of purchase originations opportunities for brokers over the next 5 years.
Even if you are not female or a person of color, you can connect with customers of different cultures and backgrounds. Most importantly, brokers must learn to build trust before moving to their sales pitch.
There's a tremendous opportunity for a great originator to get business from whether it's Latinos, African Americans, LGBTQ, but one of the most important things that they have to understand is the ability to build trust. So we tell brokers, your key to success is building and establishing trust through education, through training and learning, and positioning yourself as a trusted broker or a mortgage advisor, and then moving into the sales aspect.
Thompson also said originators who want to talk with experts about expanding their customer base can do so at conferences like Originator Connect events. For the Mortgage News Network, I'm Katie Jensen.
Buyers are starting to think that the resetting in the housing market might be here to stay. The New York Fed's monthly consumer survey found that the median expectation for price growth came in at 4.4% in June. That's the lowest response since February of 2021, and it's way down from May, when the typical consumer thought housing price would grow by 5.8%. While consumers are feeling better about housing prices, they're feeling worse about the overall economy. The median expectation for inflation over the next year ticked up to 6.8%, and unemployment expectations rose to 40.4%.
But, there's always someone out there trying to be better, trying to do better, and they need your top talent to get there.
We've seen it play out all over the mortgage industry. You invest time and money to build up your staff, only to have another company recruit away your best talent. Of course, you can't prevent people from leaving, but are you doing everything you can to make sure your employees are happy where they are? We asked NMP insider Tim Pascarella how he recruits and retains talent for Ross Mortgage, a small lender based in Illinois. Pascarella says it starts with making sure you hire people who fit your company.
I hire people, I don't even talk comp. I don't talk retention. I don't talk any of that stuff until they're willing to say that they want to work for us.
Pascarella's focused on fit over talent because he's confident he can train people if they're right for his company. But training does take investment in the right tools and, in some cases, specialized trainers. Pasquarella says don't just assume good managers are good trainers. Meanwhile, retention is an ongoing process. Companies need to make sure that they're following through on their company mission and on the promises made to their new hires. Retention can also mean letting go of people from time to time, even though that can be hard to do.
I think it's also important that if there is a better opportunity for someone who's uber talented and you can't match that opportunity, don't lie. Let them go.
You can hear more on how Pasquarella retains staff at his small company on The Principal, our daily news podcast.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.